Hey everyone, it's your favorite host, Marcus Norman of Gentleman Style Podcast Show. And today we have the founder and CEO of Legacy Wealth Builder Academy. And he is passionate educator on responsible options investing. This is a conversation that I've been looking to have for a really long time. And it's very few far in between that we are able to find experts, true experts in options trading and options investing. As a coach, a professor, he specializes in helping busy professionals, self-employed individuals, and high achievers build wealth and generate income responsibly through options investing for years to come. And so I couldn't have waited. This impactful man coming to the Gentleman Style Podcast stage today to help us do better financially. So help me welcome to the stage the incredible Mr.
Hi, Marcus.
How are you? How are you, sir? Mr. Habib,
I'm good. I'm good. Excited to be here.
excited to have you here, sir. This is unique. You are doing something very special, very powerful. And so I have been looking for an options investor for a really long time. And you, my friend, are here. I'm so glad I found you. So thank you for spending time with us. I want to start with a curveball, right? You have an incredible mind and you could do anything you want. How did you find yourself getting into options investing?
Okay, it starts with like my story. I'm originally from Egypt, and then I came to Canada about 30 years ago. And all of my uh, life, I've been a good boy, good student, good worker. They told me you have to get good education. I'm an engineer. I got a master's degree. I'm working really hard in my lot of my positions at work. My salary is good, and I'm have nothing much to show for it. I'm always struggling with money in terms of I can't go to trips, I can't do everything I want. So from a very early age, I graduated 20 years old. I knew that the job is not a place where you will become wealthy. So I have to do something different. And I learned that there are three ways other than a job. I read this book, Cash Flow Quadrant, uh, very important book for anybody to read. Told me that there's four different ways to make money. Being an employee, which we always start with that. Um, but the main three ways are stocks, real estate, and owning a business. So I started by figuring out how to do real estate, and then I stumbled on stocks. I had a very big conviction that anybody who invests in stocks is just a gambler because I've seen so many people losing money around me. And then I learned, I became very good at it. People started asking me to coach. And then how this is how the idea came in terms of going into options and stocks.
That's absolutely fair. And so it's a unique industry. And you and I are of the same mindset. Um, it seems like gambling. And for the uninitiated and for first timers, it can seem like you're taking a risk. And so it's hard, right? It's hard to figure out. No one has a crystal ball. No one knows the future. And so stocks initially looks like gambling and it looks like a waste. Oh, the market is up, the market is down, and somewhere in between, you're hoping that you're going to make some money. And so I thank you for shining a light on that. So, options trading, can you, in your opinion, share the definition of what options trading is? It doesn't have to be perfect, but what does it mean to you and how do you interpret it?
So everybody knows the stock market. Stock market, you own a little bit of a business, and if the business did well, stock will go do well at some point. Options is basically it's the right to do something. So it's the right to buy a certain stock at some point. It's a little bit foreign. It's not easy to understand, but I'll do my best.
Take your
So
time.
there's something called a put, and there's something called a call. And uh, there's a buyer and a seller to a put, a buyer and a seller to a call. So if you sell a put, you have the if you sell, you have the obligation to buy or sell at some point. If you're buyer of a put or a call, then you have the right. So if you buy the call or the put, you have the right to sell or buy, so you can control a certain stock in a certain period of time. So when you buy a stock, there's no, you can sell it after a year, after a month, after 2 minutes if you want. The option is a contract that basically has a limited period of time. It can be a month, can be a week, can be a year. And in that period, whether you're buying or selling, you have the right or the obligation to do something, either buy or sell at a certain point. So by understanding this and positioning yourself well in that time period, you can make money. It is, I have to say, it is quite risky if you don't know what you're doing. So this is not something you dabble with on your own.
Absolutely.
And what I actually specialized in teaching is I actually look for people who are very risk averse. So for people who do not want to gamble with their money. Actually, before we want to talk about options, I want to talk a little bit about the myth of the stock market itself, if you'll allow me to.
Please do. Please do.
So there are a few things here in terms of the stock market. Nobody should jump into options without understanding a little bit about stocks. Everybody's afraid of stocks because a lot of people around us lost money. And the reason they lose money is that they treat the stock market as a big casino. Nobody really teaches stock market correctly. Nobody wants to wait for the profit like Warren Buffett. So we're all calibrated to treat the stock market as a big casino, which is a big no-no. That's why a lot of people are losing money, because they don't know what they're doing. They don't know what is a good stock versus not a good stock. They don't know how does a stock get evaluated, whether it's cheap or expensive. There's so many things that as the building blocks of the stock market that people don't know. So first thing is treating the market as a casino. The second myth as well is that believing you can make money very quickly. And part of the problem with that is that there's so many ads out there of people trying to push day trading and some other like risky ways of doing things that they will tell you, they will promise you, we're gonna double your money in 2 months. Like how in the world this is even true? And people believe them. And it's so easy to lose money with this mentality. If you're going as a big speculator, or you want to get, basically treating anything like a get rich quick scheme, the chances of you making money is very low. Another myth here is that day trading is a really good way to make money quickly. The reality is day trading needs humongous amount of time commitment. Basically, you need to be in front of the screen for a long time, and it needs tremendous amount of skill. So there are different investment ways if you're busy, but day trading is not one of it. And actually, at some point of time, I tried this thing called scalping, which is going in and out in a few seconds. Extremely stressful, not very easy. But I'm here to tell everybody is that there's a way to treat it. By the way, I'm an engineer, I'm a professor. So I calculate everything. I'm risk averse as well. If you learn how to do it properly, and if you don't have this get rich quick mentality, there's a way to do it in a proper way, in a way that that you always have to balance risk and ROI. Absolutely. Everything we do in life, it's a balance between risk and ROI. So if you understand the risk and you're okay with it, and we always go for very, very low risk, and you understand the ROI, it makes sense. If you go for really huge ROI with being oblivious about the risk involved, then you're not doing yourself a favor, because a lot of times you will be losing the money.
Absolutely. What are some? Thank you for breaking that down and giving the scare, right? The history of stocks, right? Everybody is a bit fearful in that regard. And so when it comes to, what are some common mistakes you see investors make when trading options and either making a put or making a call? What are some common mistakes that you see in your expertise that people make and lose a bunch of their money?
So it's the same mistakes as doing stocks, by the way. I just want to tell you, it's actually simple. If you go do these mistakes that I'm going to talk about in the stock market, just doing stocks, you will also lose money. And the first one is not treating the stock market as businesses. We're not buying lottery tickets, we're buying businesses. So a lot of people understand that when you go and buy a rental property, any prudent person will go and ask, if you want to buy a rental property, you will ask, what is the rent? What is the expenses? Is it cash flowing? Is it in a good location? Right? Like, you'll ask some questions as a normal person. You're not going to buy it just because it's somebody of your friends told you, go buy this property. So the problem here is that for some reason, most people don't do the same due diligence when they go and buy a stock. When you buy a stock, you're actually buying a business. Like when you buy a stock in Apple, you're actually buying a piece of Apple. So you need to understand simply, is Apple making money? Does it have earnings? A lot of people go and they are speculators. They don't know. They don't look at the balance sheet. They don't know if it's making income or not. They don't know if it has good history or not of making money. We're buying businesses, and businesses, for it to have any value, the value of a business is making money. So if there is a company that does good products, but they're losing money all the time, that is not a good stock to buy. Because as Peter Lynch said, there's this is kind of the second mistake, is looking at the price of the stock as the real value of the stock. In the short term, and in the stock market, short term means 2 years. The price of the stock has nothing to do with the value of the stock. Company can be really good and the price of the stock is going down, 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 down. And vice versa. A company can be really bad, but the stock is really going up, 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 up in the short term. So there's absolutely, as Peter Lynch said, there's absolutely no correlation between the price of the stock and the value of the company in the short term. However, this is very important, the next statement that Peter said. There is 100% correlation between the price of the stock, 100% correlation between the price of the stock and the value of the company long term, which means that if we buy a stock of a good company, we know for sure it will go up because it has good earnings. So it doesn't matter the fluctuations and the volatility of the market in the short term. In the long term, which means 5 years plus, it will go up. So that's the second big mistake, is that people are too much focused on the price of the stock now, today, tomorrow, or this month, versus the long-term price of it. If you have a good stock, which means a company that's doing a lot of earnings, of course, there's so many other things we look at. We know it's going to go up in 5 years or so. So we're not really afraid. Like Meta, for example, Facebook, at some point it was $400. And then it lost, and that was like 2 years ago, it lost 80% of its value, going to $80. But Meta is a good stock. Right now, it's at 700. Okay? But if you don't know that you have a good stock, what usually happens is that's the third mistake, is that the normal people, what they do is that they buy when the stock is really, really high. And they sell when it's really, really low. It's kind of the opposite of what you should do. And the behavior of most of the people that do this basically reflects the fact that they don't understand what they're buying. You need to understand it, because again, you're buying a business. You're not buying a lottery ticket. If you go and treat it as buying a lottery ticket, you're not going to do well. But you need to buy something good and understand what you're buying.
I appreciate you breaking that down so delicately. And so one of the things, so you brought up Apple, right? And Apple is a great, great company. But sometimes you can look at the data around a company and say, well, and I've heard this, right? Apple hasn't really innovated in a long time, right? What ever since the loss of Steve Jobs, they haven't really created anything new. They keep coming out with new iPhones, right? But the technology basis is still the same. Nothing was as groundbreaking as when the iPhone first came out. And there was a huge war and a huge competition in the cell phone industry. But we haven't had a disruption like that with Apple for a really long time, technology wise and innovation wise. So in that perspective, I'm buying a piece of a business, which is absolutely true. But what could drive my thinking, or maybe other investors thinking, is this company hasn't created anything new in a really long time. So is it potentially going to go up? I can't just look at the numbers, right? The numbers, the past numbers may not give me future predictions if Apple doesn't create something soon. Just like you said, Meta, previously known as Facebook, innovated, and then they branched off into trying to create their own Bitcoin, then trying to jump into the metaverse. Mark Zuckerberg his company spent millions and trillions of dollars now hopping into the metaverse and trying to make something out there. But that's innovation, that's change. And that's a disruptor to what you and I currently know. So which one should I really be looking at? A company that's innovating and creating, but doing well. It's doing well today, but they're not creating anything. Which one should I pay more attention to?
I love the question. So it's a couple of things. Number one, Apple tried to go into something like the metaverse and didn't work.
Yes.
They paid like more than $1 billion in trying to make an electric car. I don't know if you know that.
I do.
And,
yes.
Yeah, and it didn't work.
It was terrible.
So they're trying. So I agree with you. In the phone front, they are not that innovative, but they're trying. So here's the thing, though. If we have two companies, Marcus, one of them is innovating, but they're losing money right, left, and center. Another one is not that innovative, but they're making so much money. Which one is a better business? It's debatable, it's debatable. But a good stock in my books is one that is making money. Okay, so basically, what is a business other than making money? So what is going for Apple, Marcus, is its moat. And moat is, the moat, the thing is, this water around the castle that prevents the enemy from coming and getting my castle. We look for companies. Part of definition of a good company is that not only it's making earnings, really strong earnings, but they also have a moat. Both Facebook and Apple have moats. Apple does not make the best cell phones.
Yes, sir.
They don't. But I will not buy any cell phone other than Apple. Why? Because it's integrated with my Mac, it's integrated with my iPod, it's integrated with my iPad. And it's very hard when you go into the sphere of Apple to change because people like it. A lot of the kids think it's cool. So that's a big moat. It's not just about the innovation. I got to tell you, even if they don't innovate anything, people will still buy their products. I actually do believe Samsung has better phones. But you cannot escape Apple. So the moat is very important here, right? And the fact that they are making money, and we look at a lot of things, not just the earnings, we look at the cash flow. They have so much cash flow. And when you have cash flow, same as us. If we have cash flow, we can go to trips, we can buy things. When a company has cash flow, call it free cash flow, they can buy other companies, they can buy technologies, they can afford to spend $1 billion plus in a project that didn't work, like that, right? And they're still doing well. So I don't have a clear answer in terms of which one is better, but for me, it's very simple. If they are making money and they have good ROIC and ROE, all the stuff that we know that the management are actually on top of things, and they have a good moat, that's a good company.
Absolutely. I like that. That makes sense. That makes absolute sense. And thank you for breaking that down. And so for the audio listeners, right, what he's describing is Apple they own their own lane. And it's very hard for someone else to come into that moat and take their castle. Apple has made a stand in what they specialize in, and they are the only ones in that space. And they have enough revenue to buy out the competition. They have enough money to explore, right? That's called R&D. They can do research and development, and they can fail, right? And they have so much money to fail and they'll still be okay. And so that's what he's talking about. Yes, go ahead.
I used to work for BlackBerry, and they decimated BlackBerry.
But I love the BlackBerry.
I loved BlackBerry too. I love I love the phones. I love the security. I love the keypad. The
rollerball. Yep.
I gotta tell you, when I was in BlackBerry, we were on the top. We were selling more than Apple. And when the iPhone came out, the in the inner circles of BlackBerry, we were talking to each other saying, "This is a phone for kids, for teenagers."
The iPhone.
Yeah, yeah. We were looking at this is there's no way they and they came pretty strong. And right now, like, look, if you look at the like, I know for the listeners, that would be really nice to see. Look at the stock of Apple versus the stock of BlackBerry, and you'll see a huge difference. BlackBerry was on top of things, but they started losing money. They started losing market share to Apple because Apple was innovative. Apple had was much more in touch with what market wants. BlackBerry thought that the market wants security. Not really. BlackBerry thought that the keypad of the phone is the most important thing, and it was cool for a little bit. But I totally agree with what you said. It's like BlackBerry is one of the victims of Apple.
Absolutely. BlackBerry did not innovate like the Radio Shacks of old, like the Blockbusters of old. They didn't innovate and they thought they had the market locked in. And I think around the same time, Radio Shack went out of business and so
Yeah,
did BlackBerry. But BlackBerry still holds a driving force because of their security on their phones. And so BlackBerry still continues to
correct.
dominate in that moat because they have very high security protocols and management skills, and so they get advice. I found out like some cars that have the touchscreen have that BlackBerry security technology built in them. So they've found another avenue to be successful in.
So they came back to the roots. So I think when the CEO John Chen came, I remember they said that I think it was pretty obvious by then that we cannot compete. We means BlackBerry. We cannot compete in the cell phones anymore. So I think right now they're completely out of the cell phone business. So I was part of supply chain there, and we had hundreds of thousands of phones, factories around the world building phones every day. Like when there was a problem or something, we couldn't sleep because we had factories around the globe working 24 hours. So they're completely out of the cell phone, and they went back to the roots, which is the software. So they're giving software to a lot of different places, like cars and stuff like what you said, but they're completely out of the cell phone. So they're completely out because they couldn't. BlackBerry had their own. Like another version of iOS, their own system, but it didn't work.
Absolutely. Absolutely. This is incredible. I love these conversations.
You get it from an insider. I used to work there, just like luck.
Oh, it was. I imagine that must have been Candyland for you. That must have been extremely to just see the advances and see the future literally evolve, and you are a part of it. And so that is absolutely powerful.
It was painful though, because
Yeah,
you're working for a company, you're fighting for it, and you're seeing it going down, down, down. Of course, it's never fun when people are getting restructured all around you, right? So it's like when I was at BlackBerry, I think when I went in, there was like 20,000 people working for it. When I got restructured, um, there was 2,000 people like left. So
wow.
it's a huge. Like most of my life, I'm working in companies that I started working in Celestica, which is a manufacturing company too. And again, there was so much pushing for manufacturing to go overseas in low cost geographies.
Okay, okay.
Same story again. The company was not doing bad. It's just that they were moving manufacturing. So it's pretty hard to witness the restructuring. So the first one or two restructurings usually they go for poor performance, but everybody else, like 90% of the people who leave, it's really painful. Like because they're good people, it's just that there's no work. Anyway, side
Absolutely.
note.
No, you're absolutely right. It's what I tell people now, right? When as we move forward, options trading, technology, Bitcoin, Dogecoin, all of the things we have to innovate, right? And so when you see the job restructuring or the company restructuring, right? I think Amazon had a big scare when they started to introduce the automation and the
Yeah.
robotics into their factories. A lot of people got scared and got nervous. It was like, oh, they're doing away with my position. No, we have to evolve. We have to change. We have to do our research. We have to do our data. And now my role needs to shift into more, okay, they're adding automation, right? Just like options trading, there's tools that I have available to me to allow me, which is a call or a put, to allow me to trade and buy or sell when certain criteria is met. So it's a tool, and we need to innovate and we need to learn. And that's why people need to connect with you so they can continue to innovate and learn with you and grow as the technology grows. So I really enjoy conversations like this, Mr. Habib. You guys don't go anywhere. We have a quick commercial break. Stay tuned, stay with us. We'll be right back.
If you're looking for a reliable professional trucking and logistics service, you've come to the right place. Musa Trucking is a veteran-owned and operated premier transportation provider that can help with all of your trucking and logistics needs. Musa is revolutionizing the trucking industry through strategic partnerships, the development of core personnel, and the use of cutting-edge technology. Our inventory system ensures that cargo ends up divided into the right trucks and reaching the correct destination. Our drivers are dedicated to transporting goods efficiently and safely. Contact us today to get started by visiting the website on the screen or by calling 757-756-5246.
Hey guys, this is your boy Marcus Norman of Gentleman Style Podcast Show, and we are here in Patrick Henry Mall, Newport News, Virginia. We're actually here for something unique just inside. Something new, brand new that we want to explore together. You guys ready? All right, here we go. Hey, boss. Heard you were an athlete, man. See you at the mall every day. We are at Patrick Henry Mall, living up, and we are talking about CBD. But first off, the normal thing that we all deal with is joint pain, back pain, suffer from everything.
Neck pain too.
Neck pain? You got some neck pain?
All the time, man. I'm getting up in age, you know what I'm saying? We're not young no more.
I'm with you. I'm totally with you. Bruh, CBD helps with that exact same thing. Neck pain, back pain, joint pain, all the pains, everywhere pain, right? And so that's what CBD does. That's what we're here to help you and me do. Thank you, brother. I appreciate you.
Thank you for your time.
Absolutely.
All right.
CBD is one of the most powerful cannabinoids because all it's focused on is the health and wellness. We're talking helping people with anxiety, depression, insomnia, sleep deprivation, all provided. CBD works with the natural mechanics of your body without the crazy side effects of Western medicine. So these products are here to actually align your body and get it back right so we can actually have a better quality of life. And that's what CBD does.
Support for Gentleman Style Podcast is brought to you by Manscaped, who is the best in men's below-the-waist grooming champions of the world. Manscaped offers you precision engineering tools for your family jewels. Manscaped just launched their 4th generation trimmer, the Lawnmower 4.0. You heard that right, the 4.0. Join over 2 million men worldwide who trust Manscaped with this exclusive offer for you. 20% off free worldwide shipping with the code GENTSTYLE at manscaped.com.
This is epic. So, Mr. Habib, I want to transition here for a second to a question. What are the most common? Well, actually talked about that earlier, but do you think that what you teach and what you coach to should be taught in schools? Do you think that options trading should be a part of a school curriculum, or is that too high level? Is that too advanced for our young minds?
No, I don't think it's that complicated. I would love if schools taught people about money. We don't. They don't teach about money. They need to teach about money. They need to teach that there are 4 different ways. The thing that we learned from Robert Kiyosaki, that there's an employee, there's self-employed, there's business owner, there's an investor. What is investment? What is the stock market? How to do it properly? The real estate, there are different ways to do real estate in terms of buy and hold or flipping or hold. Like, there's so many different ways on how to be an investor. But here's the thing, though. The educational system everywhere in the world is not there to educate you on how to make money. They just want you to be an employee, a good employee, which that's what they did with me. I was a good employee, and there's nothing wrong to be a good, nothing wrong in being a good employee. It's just that you need to understand that there's different ways of making money, and you cannot just be an employee. You have to be an employee and try to do something on the side. You have to be an employee and try to invest in the stock market or in options or in real estate. Most of the people, if you look at their net worth, most of the net worth is in their personal house. It's not because they saved a lot of money from their job. So I would love if schools and institutions starting teaching people about how to make money, but again, that will be in direct conflict with their
agenda,
with their objective. Right, like, which is really weird. I don't understand it. Like, I've seen some schools right now, they do it as an extracurricular activity, just like, you know what, there's an investment club or entrepreneurship club, come join the club. But I have no idea if they're teaching us calculus and stuff. That it's good, but like most engineers, like, they don't do calculus every day. But why can't they teach us about a mortgage and interest rates and inflation and quantitative easing? Like, why don't we have to learn this outside of school? It's really weird, but it is what it is. So
yes, sir.
Being responsible people, we have to understand that nobody will teach us this unless we go and figure it out ourselves.
Absolutely.
So I'm inviting everybody here I talk to a lot of people in what I do here, and everybody's hurting, Marcus. Everybody, it doesn't matter which country, doesn't matter where, Canada, US, Africa, Europe, everybody's hurting with the inflation. Everybody's hurting because we're working more and more and more, and our salaries are getting less and less and less, even if they are the same. Just because of the inflation, the buying power of our dollar or any currency we take is less and less and less. So it's up to us to do this extracurricular. For years and years, this is what I did. I used to go to 9 to 5, and they have never been 9 to 5. There's always work after 5. But I do that. But I understood that I have to, and I had to invest a lot of money in myself because, again, if your father or mother doesn't know how to do real estate investing, you have to figure it out on your own. Like, right? It's so much easier if your parents gave you the scoop of things,
The answers.
But if you don't know, you have to go figure it out. It's a little bit more risk to try to figure it out by yourself. It's more money because you have to try one thing, and then this guru is not really great in what they're doing. And some people, the first times I went to courses in real estate, they pushed us to go buy properties with credit cards. Crazy. Like, some people are really not ethical in the way they do things. But again, we're not going to cry about it. It is what it is. We're responsible people. We are responsible for our future. We're responsible for our life, regardless of what is the problems we have or adversities. So we have to go and teach ourselves. And right now we have a lot of good tools. We have YouTubes. We have people like me who are offering good education about this. So you need to go and learn, again, 3 pillars: real estate, stocks, owning your own business. Absolutely. Owning your own business will take a little bit of money and time because, again, most businesses doesn't, it needs special kind of skill, and you have to know about a lot of things, marketing, sales, and a lot of things to put it all together. You have to start with stocks and real estate. These are 2 ways whereby, if you do it properly, with no speculation, with no gambling, again, it's not a lottery ticket, and neither of them will make you money very quickly. Again, because if I tell you, for example, you know what, if you buy this lottery ticket, you're going to make $50 million. That's true if you win, That's the ROI, huge ROI. But really, let's look at the other side of it. What is the risk here? The risk is most people will lose their money in the lottery because like less than 0.001% of the people who buy the product will actually win. So again, everything in life is risk and ROI. Don't look at the ROI without understanding the bag attached to it, which is the risk.
Absolutely.
Right? Because that will not be even like realistic. As a prudent person, you need to understand that if there's something has a lot of ROI, it just means that there is risk involved.
Absolutely.
You being oblivious about the risk doesn't absolve you from the fact that it's not really something responsible to go with something that is really high ROI, high risk. So what I do, my philosophy is, I don't care about the high ROI that much. Everything I go, I'm doing very well. I go in ROI that is high, but understand that the market gives about 11% compounded. Warren Buffett, with his billions, his average is about 20%. The legendary Peter Lynch was about 29% a year. So if you're making something like 24%, that's really good. Some people telling me, Fadi, this is so low for me. Okay, good luck. Like, you are not good. You're not clear that 24%. Like like some people telling me, this is serious. I talk to people, Fadi, I need to double my money in a year. Okay, I want you to. I try to tell them as much as possible, but they don't want to hear. I want you to understand that in the quest of doubling your money every year, nobody does it. If Warren Buffett doesn't know how to do it, then why would you think that you will be able to do it? So again, if I take my car and drive it, there is risk involved. That's why there is risk mitigation. For me, learning how to make money is, like, I put it as one unit in my growth formula. That's my system. Risk mitigation is 3 times more important than how to make money. The whole game is how to not lose your money. That's kind of the first rule we learned from Warren Buffett, is don't lose your money. And the second rule is don't forget number 1. So what does this mean? It's the same as like my 17-year-old kid. He is learning how to drive. And I'm telling him that driving, it doesn't need a lot of skill for somebody to make the car move. You only need to push the pedal. The whole game is not to be involved in an accident. The reason we go
to driving school.
Driving school, we go and train. There's different levels of tests to go. There's theory and stuff. The whole thing is about not how to drive a car. It's mainly how to be not involved in an accident, right? Because it doesn't need any smartness for you to drive a car. The whole game is not. Same thing with your money. Why is it that we're not applying things the same? Same thing with your money. Making money is not that difficult. Learning how to not lose money is very important, because part of it as well, Marcus, is psychology.
Absolutely.
We are very, if you're not mastering your psychology, again, one thing about psychology is what I told you before. Everybody, if they left themselves normally, they will buy when the stock is really, really high, when it's at the peak, because everybody bought now. And when it goes down, not knowing that this is a good stock or bad stock, they will sell at the bottom. So you need to master your psychology. You need to understand that. I sometimes still refuse to go into some trades that has a high ROI because it has high risk. And if I don't know the risk, I know there's risk. That's why, because nobody gives you money for free. If there's something that with high ROI, there's something else involved in the situation. So that's what I call responsible investing. Also, one of the things I do as well is that in my program, I offer a 12-week mentorship program. In the program, I make sure that nobody uses their money in training, right? We have to use something called paper trading account. Paper trading account means it's an account whereby everything is real except the money. They give you something like $1 million. It's monopoly money, so that you can train yourself. That's the responsible way to do it without losing money. You're not going to gain money, but you're not going to lose money as well. And I get people in my program, they tell me, Fadi, I know you deal with a lot of people, but I'm very smart. I will start using real money in 3 days. And they get calibrated very quickly. Like in the first month, when they understand that there's so much things that they need to look at to be responsible, they get it. But again, that is not I know you're surprised, but that is not abnormal. Everybody hopes, Again, it has nothing to do with hope. It's very calculated. But when you invest, like when I go and buy a rental property, there's no hope in it. I know exactly what is the value of the house. I know exactly how much rents I will get. I'm not hoping that I'll get the rents. I do my work up front. I know exactly that the expenses, because I get bills and stuff before I buy to understand. I know exactly that this will cash flow $100 a month, something like that. So there's no hope in it, right? Same thing with the stock market. We're not buying something with the hope that it goes up tomorrow. That's not what we do. That's speculation. So it's, for me, it's very simple. It's very, actually, when you learn the right way of doing it, it's so far away from the speculation. You sleep well at night. You're not really afraid of anything. You know that one of the myths also that people think that the market will go up. If you have a good stock, they expect it to go up, 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 up. If you look at Apple, Meta, Amazon, all of these good companies, none of them goes up. It goes up and down, up and down. It's like breathing, up and down, up and down. And in the short term, the price of I don't look at all at the price of the stock in the short term, because it means nothing. It really means nothing. A lot of times I was in Celestica, and I know it's a good company. Celestica, by the way, is the factories of IBM. 1950, IBM said, you know IBM?
Yes, yes, sir.
Yeah, they said that we don't want to manufacture anymore. So they took the factories, made another company called Celestica. And Celestica used to build products for IBM and Honeywell and Cisco. All of these big companies, even Apple, they don't do the iPhone. They don't do their products. They give it to electronic manufacturing services like Celestica to build it for them. So we build it for them, and we put the logo of Cisco or Honeywell. So yeah, that's the same. Apple does the manufacturing iPhones. They have cities in China building this. So basically, we look at good stocks, and we understand how the market breathes, goes up and down, up and down. So when it goes down, there's nothing really, like, we're not really worried at all, right? Because right now the market is down because of the tariff war. But if there was no tariff war, it will go down because something else. It goes up and down, up and down, and the market went down, for example, in COVID. Yep. But again, why would the stock of a company goes down 50% because of COVID? The company is doing well. It's still making money. So if you understand that the market goes up and down, then it's not a reason for you to worry. It's a reason for you to capitalize on it. Because if you know that the price of the stock really has nothing to do with the value, if you know the good company, then a lot of people that understands, they just wait, and they're so happy that the market goes down, because it allows you to buy something that you want to buy cheaper,
at a cheaper price.
Absolutely. Cheaper price, right? It's a completely opposite mentality of the big herd, of everybody else, that they buy high and sell low. It needs a little bit of self-control to flip it in your mind, saying that if the price of the stock is so high, this doesn't mean that it's going to go high tomorrow. It just means that what it means is that the sentiment of the people, a lot of people buy. That's the only reason the price of the stock is high. It's not because it's a good stock.
Yeah, that's what you spoke about, and that's why I brought up that question, because it's a psychology. Once you master the psychology of the mind, and you understand that the stock is fluctuating not because of anything the company necessarily did. It's the market, it's the people, it's the you, it's the me, it's the neighbor next door, it's the CEO, it's this person, all shifting because of what they're thinking and what they're seeing. But that is not an indication of what the company is actually doing. It's the people, it's the person next to you who says, oh my gosh, there's a war in Syria, let me sell. And so if enough people sell, that will drive the stock to move, but the company has not changed at all.
What does have the war in Syria has to do with the Apple operation? Nothing, right? The way I look at it as well is that the short term versus long term, it's like buying a personal house because your wife likes it, or buying a rental property. Okay. So you look at it as well in the way they evaluate the price houses. When you look and buy a personal house, how do they figure out the price of the house? They do something called comps. They go look at the solds in the area, okay?
That are similar.
That are similar.
Yep.
Basically, it all has to do with the sentiment of the people. If they think this is a good area, if it has a lot of flowers, then the price of the house will go up. If it's in a place whereby there's not a lot of flowers and trees, the price will go down. So that's how personal houses are evaluated. Now, if you go to a commercial property, like a rental house that is like 10 units or something, it has nothing to do with how much is sold. It has to do with the cap rate and the NOI, net operating income. How much, it's a business. So it's completely different. It's a business. How much money the business, not the property, is being sold. Is generating. So completely different. The people go to the stock market thinking it's a personal house. They look at what other people are buying,
Yep.
but it's not. It's a commercial property. It's a business. Look at how much money they are making. Are they making money or not? So, right. So the way I talk to like my students is that I don't care if you think the company is doing great products. I like BlackBerry, but I will never invest in BlackBerry right now. Why? Because if you just one small look at their income statement, you will know that they've been losing money like 4 out of the last 5 years, that they have zero free cash flow. Not investable for me. By the way, 1%, like there's about 6,000 companies in the US stock market. There's only 1% that is investable, right? Mm-hmm. So if you there's some actually screeners you can use, very easy screeners, free screeners, whereby it can reduce the 6,000 to like the top 100 in terms of if they're making money or not, they have free cash flow or not, they have good ROIC or not. So it's actually not that difficult to figure out what is the 1%. And then you focus on the 1% that, like Warren Buffett tells us that you only need like 10 or 15 of these stocks to be very, very rich. Like it's not, by the way, when you learn it, it's actually very simple. Right. It's very simple. There's so much confusion out there.
Absolutely. This is powerful and this is epic. I wanted to ask your thoughts because now we are in the age of artificial intelligence and algorithms. And so do you teach your students, or is there any possibility that you add artificial intelligence to how you do a buy or a call or a put? Have you integrated any artificial intelligence AI to your teaching?
So the integration here is, number one, we need to understand that the market goes into revolutionary cycles. So one cycle was the internet, right?
Yes, sir.
Another cycle was the mobile, right? It's so huge of a revolution that right now our cell phones is more powerful than the computers 20, 30 years ago. When I went to university, I didn't have an email. Right now, yeah, I'm not that old, but again,
you look good. You look good.
Right now, we're at the start of the AI revolution, yes. Which means like a lot of people made a lot of money in Apple. Apple went up like something like 1,000% or more because there was a revolution that helped the mobile industry. Right now, we're at the cusp, at the start of the AI revolution. So one of the things we look for is companies that are doing well, that are working in AI, like NVIDIA, like Meta. Okay, so NVIDIA went up really, really high in the last few years, but it's going to go up much more. Again, please don't take this and go buy NVIDIA because it might be very expensive now, right? Just like put things. Please don't trust anything of I say. Like anybody talks about money, by the way, this is how I start in all of my lectures and in my talks. Please do not trust anything of what I say. As a prudent person, anybody talks about money, you need to be very skeptical, very skeptical. You need to make sense of what you're hearing. If somebody taught you a way to get money, you need to try it in paper trading, because if you're not making, that's what I teach people. If you're not making money in paper trading, you have no business putting your own money and trying this. Because I tell them, if you're not making money in paper trading, trading account, it means that either what I taught you is wrong, or you're making mistakes, or you didn't understand it. Basically, you don't have. Once you know that you're making money consistently and all the mistakes are done in paper trading account, then you go further. So I don't use any bots or stuff like that. I don't think this is correct, but I capitalize on on the companies that are in the that will ride the wave. It's like a wave. It's like a sea. There are waves. There are waves that will push some stocks really, really high. And again, not all AI companies are not all created equal. So you look at AI companies that are really good, but you need to understand that we are at the start of this AI revolution right now.
For sure.
The last year or so was humongous in terms of AI. Right now, I do a lot of AI. Like one of the things that AI helps me a lot in many, many ways. Like one of the things I did that was really eye opener for me is I got all the testimonials and videos that I did, like this video that we're doing right now, and I fed it to ChatGPT, and I told him, please analyze for me what you're seeing. What do people see as good and bad? And it was eye opener. They came back saying, listen, these are the words and sentences that people repeated, like confidence, that the fact that they like the implementation. So things that I would have never knew by just looking at like 20, 30 different testimonials by themselves. And they gave me things that I can improve on. So one of the things that everybody should know is you start learning a little bit more about AI and how to use AI to make you better in whatever you do. AI is used a lot in marketing, in every walk of life right now. And it's not going to replace... Yes, it will replace some jobs. But again, if you know AI, it makes you more valuable, whether employee or a business owner, in whatever you do.
Absolutely.
Because it actually saves money and saves time. That's what I meant. It saves time and money, of course, makes you much more efficient and shows you stuff that you will never have done by yourself with our limited brains.
Absolutely. I wanted to touch on something that you mentioned in the beginning of this podcast episode, where you mentioned that you could really spend a lot of time researching different corporations, even though there's systems and there's screeners that can minimize it just down to the 1%, right?
Yeah.
So even 1% of 6,000 is still a couple hundred, right?
Right.
And so you can get bogged down in research after research after research. And so how is that any different from a 9 to 5? What makes options trading superior to a 9 to 5? Because if I'm spending 8 hours researching and studying these businesses before I invest, I could do the same thing at a job and earn an income at my job, spending maybe equal time. What are your thoughts on that?
Okay, so a couple of things. Number one, it's never a full-time job to research stocks. That's not what we do. So I can give you a free screener. Maybe you can put it to your audience. But basically, the starting point here is that there are screeners whereby you can search for certain parameters in the different companies. Like, for example, if you put to the screener that I need the earnings to be at a certain limit, like if you just put I want the profit to be more than zero, half of the companies, a big portion of the companies will be thrown away. The 6,000 becomes 3,000. And then if you tell them I want free cash flow more than a certain amount, half of that is out. So now you have 1,500 versus 6,000. So, and there's so many parameters you can choose from. If I want ROIC, for example, return on invested capital, more than 15%, a big portion of that will go out. So you can stop whenever you want. You can end up at 100. You can end up at 10 if you want. So it's not that it's a full-time job to search companies. So that's not what we do.
Okay.
And but it's a starting point. You can get 20 companies, for example, and then each one of these companies, again, it doesn't take a lot of time when you know what you're looking for. You go look at the income statement, balance sheet, and free cash flow, and again, you can easily understand what are these. It's actually very important that you understand these and understand where to look. But the idea is very simple. You want the company to make money, and you want them to be using the resources efficiently because it shows that they have good management. And you don't want to see that they have a lot of debt because that's also a risk. So it's not a full-time job. The other thing as well is this. Options is a place whereby you can do it for like 15 minutes a day, the way I teach it. It's not a full-time job. It's not supposed to replace your job from day one. So we're starting with people who have full-time jobs because this is where I was. And after you go through 12-week program, or once you understand what you do, all what you need is 15 minutes a day to maintain the trades that you have.
15 minutes.
Yeah, 15 minutes, 20, 30 minutes max.
Absolutely.
But once you know through, like, the 12-week is...
How much money should I have to start? How much money should I bring? I know you said in your course we're gonna start off with monopoly money. We're gonna start off with fake money. But how much money should I bring to the course when I'm ready to start trading live money?
So we'll start with zero.
Okay.
But you should have about 10K because the way we do it, so in options, there's like 30, 40 different strategies you can use. I only teach 2. And for me, there's a lot of courses out there that teach the 30 of them, and you go out of the course like hearing about the story of the 30 strategies, but you're not really trained on any of them. Mine is very different, and mine is not even a course. It's a mentorship program. So I focus on 2 strategies, maybe 3, but we do them 10,000 times. Every day I ask people to do a few trades, and again, it's paper money, so they cannot, for me, I like it because when they make mistakes, it's beautiful because it's a teaching moment for me. I get everybody and say, listen, this is a mistake. Everybody understand that this is a mistake. Let's not do it again. And it's paper money, so it's safe. So we use paper money, and and because I teach selling puts and selling calls, and the reason we do selling, by the way, just for the listeners, is that when you sell options, your ROI is not huge. You cannot make unlimited profit. It's certain profit that is very good for me, like 24%, 30% is really good. Versus buying options, when you buy options, you have unlimited profit. But the probability of you making the profit is small. So same as the lottery, huge ROI, unlimited profit. But the probability of you making the money is really, really low. So in selling options, you have 75% chance of going it if it goes your way. In buying options, it's only 20, 25%. So I'd rather do a lot of wins, smaller profits, versus the lottery ticket kind of thing. So it needs about 10K because in options, you don't deal with stocks, you deal with contracts. And a contract is 100 shares. So you need to have the money to buy the stock. You don't have to buy the stock, but you need to have the money to buy the stock if it went down. And again, we put ourselves in a position whereby if it goes up, down, or like sideways or down, we are okay with the 3 because we understand the 3 and the risk of the 3. And we only do it on good stocks, because the worst thing that can happen is that I will buy a stock that I already know that it's good and I already want to buy it. I know it might not make sense to people, but we put ourselves in a good position whereby if it goes,
you're doing great.
If it goes either way, we're good because we understand the risk. Like, it's not that we're hoping that it goes a certain way. None of the hope. If I will end up buying Meta at 100, I'm so happy that I do that because I know it's a good stock. So I know that if I do nothing, if I just wait, it will go up. Same as the people who bought it at 80 and waited a couple of years. Now it's 700. So it's not a full-time job. Options, once you learn it, it takes about 15, 20 minutes. And you can do it from your cell phone, by the way. So for example, I went to Disney a few years ago with my kids. And while I was in the
ride,
not the ride, the big queues, like, the waiting for the ride, I used to, on the cell phone, I used to make a trade to get the amount of money in the trip. So to answer your question, it needs about 10K. Absolutely. And the reason is because if the stock is about 100K, 100 times 100, because one contract is 100, it's about needs to 10K. But again, this is not a promise or anything, but the ROI of the people around me and the people I teach ends up being about 24%, maybe 30%. But again, it depends on people, because one of the things also is that one trade can be really good for some person. It might not be good for another. For example, I tell them, if your account has $2 million and your net worth is $20 million, they can take a trade and it's a little bit more risky and they don't care about it because they have so much of their account. But if your whole life savings is 10K, you need to be a little bit more conservative, right? And you need to be okay with less ROI but less risk, because that's so again, it needs a little bit of understanding of everybody's situation and being responsible. Like, again, the worst thing that can happen is treating this as a gambling casino, because it's very exciting that it's that you treat it this way, but that's not responsible. That's not like that. that's not the right thing to do. You have to be very responsible, and the people who are responsible end up like Warren Buffett, right?
Absolutely. Can I get into, can one of the students, once we start buying the contract, how soon can someone start making money? And I'm not trying to tote the bandwagon of a get rich quick, right? Because we're still playing the long game, right?
Yeah.
This takes time, but how soon could someone make money with trading options?
So I'll just start with the simple selling puts. So selling puts is like selling insurance. Like I for example, I've been paying for I don't know 30 years insurance for my car. Who's making the money? The insurance company. They're making a lot of money, right?
And you
Because
never had an accident.
Yeah, I have not been in a lot of accidents, and whatever they get paid in the accident that I did was nothing compared to the money they made. Okay, so a put is like insurance. So the insurance company sells me the insurance, and I'm the buyer of the insurance. Okay, so a put option seller has the obligation. Again, here the insurance company is the seller of the insurance, is that when something goes wrong, they have to pay the money. Okay, a seller of the put. Let's take this scenario, but we're gonna give me 2-3 minutes because like
Absolutely.
Okay.
Yes, sir.
So let's say that there is a stock that we know is a good stock. Let's say XYZ is a good stock. We know it's a good stock. It's at $200, and I do want to buy the stock at $200. Okay, so that's the starting point. There's a stock on the stock market called XYZ. It's a good stock. It's at 200, and I know its value is more than 200. So I want to buy the stock at 200. Okay.
Right. Okay.
Bob is someone who has the stock. Okay.
Okay.
But he is so afraid that the stock will go down to 180. He doesn't understand that this is a good stock. He doesn't care. He just cannot psychologically withstand that the stock goes down to 180. So he comes to me saying, Fadi, I heard that you want to buy XYZ. Can we agree together that if the stock goes down to 190, that you will buy it from me at 190? And I say, yeah, because I want to buy it at 200. I know it's a good stock, and it will be even better for me to buy it at 190. Okay.
Right.
So I'll say, you know what? Yeah, I'll make this deal with you. And then Bob told me, listen, if you agree to do that with me, I will pay you $5 today, just because you agreed to do this with me. And I say, that's a sweet deal. I want to buy the stock at 200. I'm going to agree with Bob that if it goes down to 190, I will buy it on 190. That's even better. And he's going to give me $5. Which means that really I bought it at 185. That's a really sweet deal.
It is.
And that's really selling the put. In this transaction, Bob is buying the put. He's buying the insurance. I am giving the insurance to Bob. I am selling the put. And because I'm selling the put, once a certain condition happens, which is the stock goes down below 190, I will have to buy it at 190. Here's the thing though. I get the $5 on day one. And that's why we use it as income generation. It can be used in income generation or wealth building. So on day one, by the way, the contract, we usually go for a month. So in this month, the stock right now is at 200. In this month, if the stock goes down below 190, I will have to buy it at 190. If the stock did not go to 190, stays at 200, then we call it the option expires worthless, I made the money, the $5, and I go and sell another insurance to another person. And if the stock price goes up, so basically if it goes up, stay sideways, or go down a little bit, like went to 195 or 191, in all of these scenarios, I made the money, and then I am not required to buy the stock. The worst case scenario here is that if it goes down below 190 and I have to buy the stock, I'm happy because I was happy buying it at 200. I'm going to buy it at 190. I already made $5 anyway, so my break-even point is 185, even lower than 190. And that's it. I'm going to wait a little bit, and we do something called covered call. So I don't want to confuse people. But bottom line is, when can I get paid? From day one.
Absolutely.
Okay. But you need to understand, because again, I make it simple. People told me that because I'm a professor and this is what I do, I please don't think it's that simple. It is simple, but it's not easy to do. There's risk mitigation you have to do around it. I do want to scare people that if you don't do it correctly, a lot of people lost a lot of money, because it's not a joke. It's not a joke. Be responsible, make your own due diligence, and learn it properly.
Absolutely. This has been an epic conversation. This has been absolutely phenomenal. I enjoy this. And so, Mr. Habib, thank you for making time today and sharing space and giving back and sharing your insight. How can people find you? How can people connect with you? How can people learn and start the 12-week course with you?
So I sometimes do free challenges so people can learn a little bit more about it. So if you can email me at info@Legacy Wealth Builder Academy, info@Legacy Wealth Builder Academy, I can hook you up.
Absolutely. Connect, y'all. This is absolutely amazing. And so this is how you build legacy wealth, y'all. Connect with Mr. Habib. Get in the 12-week course. Is the course virtual or in person?
It's in Zoom. So I have students all around, from the East Coast, West Coast. Some people are in Africa. Like, so there's so many people, like, you know, we agree on a time that will work for the small group, and it's virtual on Zoom.
So it's a small group. So are there limited seats? Are there limited seating?
It's not limited seats. I don't want to like artificially say it's scarce, but I don't, like, you know, the biggest group I have, it's a group learning, it's a group coaching, and it's not a course. It's not something that because I've been to courses like this, people give you the videos and they just forget about you. It's not like that. This is implementation. You cannot hide. I'm a professor. You cannot hide. So people every week, they have to share their paper trading account. Again, there's nothing confidential. It's paper trading. They have to present to the group their trades, and we quiz them. Why did you do this? What is your ROI? What should you do now? So people have no way out of this 12-week program other than to be good at it, right? Because I'm very committed to not just selling the course because it's a mentorship. I'm committed for people to be at a point whereby they're so satisfied, they learn a lot, and for them to be able to recoup the investment they made.
Absolutely. There you have it, y'all. Connect. We gotta let this incredible gentleman go. He has many more courses to have, much more insight to share, and much more wisdom to share. Thank you, Mr. Habib. Thank you,
Marcus,
for being
here. It was my pleasure. Thank you.
Absolutely. And like we end every show, thank you all for tuning in to the Gentleman Style Podcast Show. I hope this has served you. I hope this has helped you all, take you all to the next level. Let's get it. So like we end every show, take care of your friends, take care of your family, and always take care of business. This is Marcus, your favorite gentleman, and super fragilistic espialidocious, the incredible Fadi Habib. Signing off. Love you guys.